Welcome to the Monday Futures Market Outlook for November 14th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. We plot an 80-week moving average on there. It's a very good job to depict the bull and bear market cycles that the market has gone through. As of this moment, we're actually trading above that 80-week moving average, taking the market out of the bear market territory, and we're now seeing whether or not the bulls will follow through to actually beat the 2011 highs. That's something that we'll see the price action over the next few weeks develop, and whether or not we can exceed these current 1260 levels on the upside will give us a lot of indication as to where the next primary trend will be going for the upcoming new year. Just to make some key intermarket observations, we have seen the key bottoms of the stocks and commodities for the 2011 year. Doesn't mean that 2012 cannot turn bearish, but it is very unlikely that that any stage for the remainder of this year that we are going to see another major leg lower. Overall, the last 2 weeks represents a market consolidation after a very strong October month, and it is likely that overall that the market could break out on the upside this week. We'll see what kind of follow through there will be on Monday and Tuesday as we go, but overall investor fears have been quickly snubbed out by greed as investors have the fear of missing out and money is flowing back into the marketplace. We remain optimistic, but we have to also recognize while saying that key overhead resistance levels on most markets have yet to be exceeded, and therefore we cannot technically rule out the possibility that the market struggles and subsequently rejects at key overhead resistance levels. So it's very important to be cautiously optimistic. Next here, when we take a look at the S&P 500 on the daily charts, one thing we've been talking about for the last 2 weeks is that if we were to see a consolidation, we'd want to see it contained to the 1200 to 1180 area on the downside, sort of that area marked off by the blue box. Overall, if it was, then the entire consolidation would emerge as being simply like a flagging or triangle formation, and subsequently lead to a bullish breakout on the upside that may gun for the highs of the year. This scenario at this stage continues to be the most likely scenario. Of course, we cannot rule out the possibility of some catalyst news event occurring and changing the entire sentiment of the market, but so long as things stay stable, the path of least resistance will be for this market to attempt another significant push higher into the December month. Next year, when we take a look at the US dollar index futures, if you take the highs and the lows of the year, we're sort of right in the middle of that trade range. At this juncture, we're very neutral on the US dollar, as it hasn't really shown any characteristics to have followed through on that really bullish push it had in September. But in the same regard, it doesn't look like it's ready to collapse either. So more than likely, we'll probably see 2-3 point swings higher and lower, and then subsequently returning back to the mean midpoints, and it'll continue probably chopping for the remainder of the year. Next year, when we take a look at copper futures, copper has put in that double bottom back in September, October, and is now just simply consolidating after a very bullish breakout in the last week of October. At this juncture, this right now still fits all of the characteristics of a Fibonacci retracement, and as a flagging wedge formation that could very bullishly break out. At this stage, that nice green candle that came in on Friday, if that has any substantial follow through, particularly above the 360 level on copper, it would certainly leave the window open for a full retest of the 380, 390, and $4 levels on the upside of copper going into the December month. Next year, when we take a look at crude oil, and we were talking about that so long as little consolidations were contained around that $90, $92 area, that the window would remain open for crude oil to make that push up to this 100 level. And now we're actually now approaching that level. We do believe that this level should act as a substantial overhead resistance. It doesn't necessarily mean that crude oil will have a substantial sell-off, but we should probably see far more range-bound sideways price action start to develop up along these top end zones, unless there's some sort of a very bullish oil catalyst out there, or even driven by a very weak US dollar, there's certainly the possibility of an even further push. But more than likely we're going to start seeing oil struggle up here over the next $3-4 on the upside. When we take a look at gold futures, after the failure of gold to break down back in October, the subsequent reversal consolidated very solidly above 1700, and just like we were stressing last week, so long as gold's price action remains above the 1700 level, the window is open for gold to strengthen right back to its highs around that 1900 level. It doesn't necessarily mean that we think that gold will be heading up to 2500 in this push, but really at this juncture there's no immediate reason to be bearish gold from the technical price action here. Finally, I want to take a look at the 30-year Treasury bonds, and the Treasury bonds have put in a double top up back in September, and more or less have consolidated. Really, the last 2 weeks have seen a very quick and fast reversal back up on the Treasuries, but we were stressing that if Treasuries struggled here in this blue zone in the 41 to 44 area and subsequently reversed, that in fact that would be a failed almost right shoulder of a topping formation, and subsequently could lead to the beginning of a Treasury bond correction that could see it easily get back into the 120 to 130 area over a 2-3 month span. A weak Treasury market would be very bullish for the stock market, and I think the stock market is really waiting for its cue with the breakdown of Treasuries. So really we're going to be watching this 140 level on these 30-year Treasuries. If we see any breakdowns below 140, consider that to be a positive sign for the stock market. That was the Monday Futures Market Outlook. Thank you for joining me.